Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, today starts the busiest 5-day stretch of the year. So will the consumer consent? People aren't buying homes, but home prices keep going up. Why is that? Tech stocks, well, they're on a tear. So does this sector have more legs to run in December as in November? Tonight, we're going to be talking with the founder and chief investment officer of Treasury Partners Investments, Richard Saperstein, with $28.2 billion of assets under management. Richard Saperstein coming up on this Black Friday. It sounds kind of ominous, but we're glad you're here. For the next 28 minutes, this is Wall Street Wrap-Up. Hi, welcome. I'm Andre Laborde. On this Friday, November 24th, I hope everyone had a happy Thanksgiving. Well, today starts the busiest 5 days of shopping for the whole year. So what is the condition of the consumer? Well, according to Adobe online sales for year over year, in November it was up 5%. And for toys, for last month it was up 76% compared to the daily average sales last month. The National Retail Federation expects that this year, 72% of you will be shop either in store or online for this weekend. Now that's an increase from last year when the percentage was 69% of you were either in store or online. Now this weekend, many may go because of the deals, but many of you just may be out of tradition. The National Retail Federation expects today through Monday that 0.75% of you will be shopping with an average spending per person of $567, and that's up 13% from last year in 2022. But this year, there'll be more challenges to make those numbers because of gangs going into stores to shoplift and theft. Many of your favorite items are going to be locked up, and if staffing is smaller than last year, the lines and wait times to get those higher ticket items, they may take a little longer. So, how did our money do this week? Well, as of Wednesday's close, energy was the only negative sector, falling after announcing the delay of the OPEC Plus meeting. And as of Wednesday's close, the Russell 2000 was lower for the week. Big tech stocks all higher today. Top sectors for the week were communication services and healthcare. As of Wednesday's close this week, Dow Jones closed up 0.9 of a point, and the S&P 500, they closed up also up 0.9 of a point, and the Nasdaq closed on Wednesday up 1% for the week. Jeff Bezos is the founder and one-time CEO of Amazon, also owner of the Washington Post. Well, he's selling just over 1.5 million shares of his stock. He was living in Seattle, Washington, but he's moving along with everyone else to Florida. Plus, he's also getting married, and it sounds like it may be quite expensive. According to an NBC poll this week, the public perception of Biden's handling of the economy, almost 60% of you disapprove of his handling of the economy, while 38% of you approve. Today is the official start of the holiday shopping season, and the question is, many retailers are hoping that consumers will be parting with their money as in past years for Christmas and the holidays. According to the Federal Reserve Bank of New York, the consumer credit rejection rate has hit over 20%, which is 2% higher than it was last year. Consumer spending is key for the shopping weekend. Shoppers are expected to spend on average of $567 between today through this coming Cyber Monday, and that would be a new high. Goldman Sachs this week points out that of the 500 stocks of the S&P 500, 73% of the gains of the S&P came from just 7 stocks versus only 6% from the other 493 remaining gains. So, how will the stock market surge since the beginning of this month affect the remainder of the year into next? And is technology the place to be, or should be? Should we be looking for somewhere else? Tonight, my guest is Richard Saperstein. Richard is the founder and chief investment officer of Treasury Partners. In fact, Barron's has named Richard consistently since its rankings began in 2004 as the top 100 wealth managers with over $28.2 billion of assets under management. Best of all, he's here with us tonight. Hi, Richard. Welcome to Wall Street Wrap-Up.
Thank you. Pleasure to be here.
Richard, we've had a great November, and this is Black Friday. We're about to be going into December. Do you see stocks as going to be continuing their trek upward as we've had so far in the last weeks of November?
Well, I think when we talk about stocks, we've got to look at two markets. There are the Magnificent Seven, which are up dramatically this year, and there's the other 493, which are up just 4%, leading to the overall S&P up 18%. So when we talk about stocks, it's really a bifurcated market. As you probably know, we're overweight large cap tech. We'll continue to be overweight large cap tech. And I think if the rally continues, it'll likely broaden out to some of the other sectors that are showing more value.
What about those 7 stocks? Do you prefer to own those specific 7, or such as an ETF of the S&P, but you've got the other 493 as well?
Well, we actually use a combination of individual stocks through separately managed accounts, as well as ETFs. And this comes back to optimizing a client's portfolio and where is the most efficient way to deploy capital in the equity markets. And so we have found that a combination of ETFs, direct drive right into the sector or into the market, is highly efficient to capture 100% of the upside. With separately managed accounts, it is possible to capture different percentage of upside downside capture. For example, with certain separately managed accounts, our experience is, let's say, 95% of the upside, but only 85-90% of the downside.
For big tech and also for those 7 that you were talking about earlier, do you think that there's still more room to run, that they're not overbought?
Well, they're clearly overbought if you look at them simply on the basis of the PE ratios. But I think we have to look at the market differently today than historically over the last 20, 30 years, simply because today the M7 can contribute 28% of the market value of the S&P, and they're trading at a significantly higher multiple than all the other stocks in the index. So that in turn leads to a higher overall PE ratio for the S&P. So we can't really look at today's levels and say, well, we've got elevated PEs, so the market's overvalued, simply because we've got, a higher proponent of growth stocks in there that have, wide moats. They've got recurring cash flows. They're growing faster than the S&P, and they deserve higher multiples.
And Richard, I think that's a good point, because also thinking about like this week, going from last Friday, a week ago, they had Chat GPT, and the CEO was fired over last weekend. And then within a course of 48 hours this week, by the time we finish this interview, he may be back at ChatGPT, or he might be with Microsoft, or he might, because now companies like Salesforce and Microsoft are telling people that any tech that wants to leave that company, OpenAI, and go with Microsoft or Salesforce or others, they'll match a salary. So there's a lot more room to grow. I guess what you're talking about, of Microsoft right there, or NVIDIA.
It reminds me of the line, "Should I stay or should I go now?"
Right.
And by the way, it's emblematic of the feeding frenzy for high-grade engineers in this AI space. And so it's clear that Microsoft has a dominant position. It's being reflected in the stock right now. And when we look at it, investors who aren't long or don't own a portion of their portfolio in these large cap tech stocks, they're going to underperform. And, this feeding frenzy for talent is emblematic of what's going on and the value of that potentially in the future.
Do you think that I know I get calls and people ask and write me about who want to invest into the AI, artificial intelligence. So I imagine, like, let's say your clients and say, Richard, I want to get involved in something like this. What would you tell them?
Well, our discussions are really about asset allocation. And,
Hmm.
that's one of the larger drivers of returns. And so if clients have proper asset allocations, they can certainly have a portion of their equity sleeve in large cap tech and benefit from any developments in AI. Yet to go out and just randomly take a portfolio and commit a proportion to one particular sector and one particular technology, it raises the volatility and the risk of a portfolio. And for clients at Treasury Partners, where the return of capital is more important than the return on capital, we focus on asset allocation and proper portfolio construction.
Let's talk about asset allocation and let's say diversification. I would imagine instead, rather than, let's say, unless you get an inheritance or you sell maybe a piece of property and get a one lump sum, the average investor would have money coming in from their weekly paycheck or monthly savings or maybe their annual savings. So do you have a preference of, let's say, diversification? Would you prefer that a client or an investor add to an already existing investment or diversify more into other areas?
It depends on how well diversified the investor is. So we utilize a three-dimensional portfolio with stocks, bonds, and hedged or alternative investments. And clients should look at the historical returns of these different sectors, the risk and the volatility, and assemble a portfolio of either one, two, or three of those different sleeves. Now, if clients have incremental money and an existing asset allocation that they're comfortable with, they would reallocate across the three sleeves. If clients are underweight in a certain sector or don't have exposure to one particular sleeve, they would want to start building in that sleeve.
Maybe mid-September or so. I remember either reading or seeing you on another financial channel, and you were talking about there were the other opportunities outside of equities and stocks. Is this what you're talking about, of the different sleeves of maybe bonds, or what were you discussing?
Yeah, so it's very important for investors to realize that an asset class that was really entirely uninvestable for 15 years is now investable, and that's the bond market. In turn, yields on bonds have jumped very significantly to the point where they're very attractive and they provide several benefits to client portfolios. Specifically, at these levels, owning bonds provides income. Secondly, it provides ballast against a declining stock market, meaning that if stocks go down and there's a flight to quality, investors will likely buy bonds and drive the price higher of the bonds. And finally, the bonds provide protection against the slowing economy. So if the economy slows and interest rates go down, bonds, which work like a seesaw, as interest rates go down, the value of the bonds will go higher.
What about credit? There's a private credit I'm thinking of. Today, there's that area of investment has gotten to be very enticing to a lot of investors. Are you involved, or do you like that area of private credit?
There's a lot of different ways to participate in private credit. Our focus right now, and what we're aggressively buying and have been for several months, is very high grade municipal bonds, where investors can basically buy bonds in the municipal market and earn 4.5% tax free. 2 weeks ago, it was 5% tax free. So if we're sitting down with a client and discussing the target returns over longer periods of time. Let's say a client wants to double their capital in 10 years. So that means they have to earn 7% tax free over that 10-year period. If I can start off the portfolio with 4.5% tax free in a very safe bond investment, then it reduces the amount of risk that is needed with the balance of the portfolio. Remember, we talked about an asset allocation, the
Mhm.
balance of the portfolio that has to be allocated to equities to drive those higher returns. So it's very important to identify first what's the target return, and then how can we backfill to get there with I guess, the least amount of risk in doing so. Now, private credit would benefit and could be opportune for a very small 1 to 3% segment of that risk bucket. But at these levels where we can get a pre-tax equivalent of 9% with a municipal bond, we're heavily focusing on that right now.
Private equity is now going into the area from only a select few to now wanting to get into more mainstream, that they're selling shares and such like that. And when you're talking about asset allocation, is that something that would be of interest to, as an investor, for you think I'll use the term, the mom and pop person of a private equity type of investments?
No, that would be inappropriate due to the illiquidity, the lack of transparency, and the elevated costs of accessing those investments for a small investor. Uh, you can look at it like PE, private equity, and private credit for that matter, are only appropriate and suitable for investors that could really withstand the illiquidity of those investments. And that really leads to a very small allocation after first filling the baseline of a client's investment portfolio.
And that's a very good point, because I think a lot of people don't know is that, as a stock or an ETF, if you want to go ahead, or mutual fund, if you want to sell it, it does just from a push of a button and you get your money back right away. But with private equity, you've got to wait 5 years, 7 years, down the line for doing something like that.
Yeah, having been a practitioner for over 40 years now, there's one thing I come to appreciate, and that is liquidity. So when the problems hit, and tail risk events occur, whether it was from Black Monday in 1987, we've had them, the S&L crisis of '93. So investors should recognize that if they're going to have illiquid assets in their portfolio, they've got to size it properly so they have adequate offset of liquid assets in the event of those harmful environments occurring.
Richard, at one time, well, right now, oil for the last week or so, oil has been down, and for those who want to fill their tank up, they're saving 8 to 10 cents, 12 cents a gallon, but for the moment. And at one time, I know you were very bullish on oil stocks. Is now a good time? Are you still bullish on oil stocks and E&P, and also or do you think that this is a good time to get in?
We like oil. We have filled our tank up, and there's a couple of reasons for that. So we like buying certain stocks with high elements of operating and free cash flow. Now, the oil patch, depending on where you're marking the price of oil and the company, the operating cash flows are ranging anywhere from 12 to 20%, and then the free cash flow from 10 to 16% on the companies that we own. Now, what that means is if a company has 15% free cash flow after their operating expenses and their capital expenditures, it means they've got a lot of money to return to shareholders through dividends and stock buybacks. In an environment where we have higher interest rates and volatility in the stock market, we're comfortable owning a portion of our portfolio in that sector, which has high attributes of free cash flow that'll be returned to the shareholders. Now, the other side to that is, hey, wait a second, we're all going electric and we're not going to need oil so fast. Well, we don't think that's happening for decades, where the internal combustion engine will still be around for a while. Airplanes will still need oil, and unfortunately, it's here to stay for a significant period into the future.
Richard, I completely understand and agree with you on that. I know, what most people don't realize, anything from lubricants to plastics to vinyl to the things that most people don't even see, they automatically believe that just because of the fact of gasoline in your tank is the only use of petroleum, and it's just not the case. So, but totally understand. What do you think? Saudi Arabia right now, and with OPEC, they've had production cuts in the past. If oil stays at a lower rate as it has been, do you think that Saudi Arabia and the other OPEC countries are going to be wanting to do more cuts?
Uncertain, yet there's two things to consider. One is, as the price goes down, they're more incented to restrict output. And secondly, the Strategic Petroleum Reserve is at the lowest level in years. And the president has indicated that he will look to refill at certain price points. So there are two factors that could keep the price of oil from dropping too much. We'll see what happens, but the names that we own, and in general, the oil companies that we follow and have invested in, will do well at $70 oil.
Last week, Home Depot came out with their third quarter earnings. We're now in the fourth quarter. And I know at one time you were very high at Treasury Partners with Home Depot. Do you still like Home Depot? And what do you think the future of it for that company right now?
Well, there's an interesting dynamic going on in the housing market in that mortgage rates now are 8%. So all the world that has refinanced into a 2.5%, 3% mortgage is effectively locked into their existing housing stock. Mm-hmm. And what's going to happen is new home sales, as we see right now, are slowing. And you can look at the NAHB, which has been declining, as emblematic of that decline in sales. And at the same time, our outlook is for existing homeowners, rather than moving because they would have to assume a prohibitively expensive new mortgage, they're going to do more remodeling. And so they'll, remodel the kitchen, add some room to the house. And that would cause greater demand over at Home Depot and likely for Lowe's, for that matter, which we don't own. So we own Home Depot, and we continue to like that name.
We've probably had the most anticipated recession that hasn't occurred yet. Okay, do you think we're still in store for a recession? And if you do, how should you prepare for one?
Oh boy, this is like ground control to Major Tom. Can you hear me?
Do you think the Federal Reserve has done a good job of a soft landing?
The facts on the ground suggest a slowing economy. Leading economic indicators have been down for an extended period of time. M2, the liquidity in the system has been contracting for a very long period. Manufacturing orders are down, bankruptcies are up, credit card debt is up, unemployment claims are ticking higher. Internationally, the global economy is slowing down. So, if you look at the data, it suggests a slowdown. Yet, if you look at the stock market, it suggests that it's all clear and the Fed has orchestrated, that soft landing which you suggest. Our view is that the economy is going to slow and eventually rates will go lower. And by owning bonds out 10, 12 years, as rates move lower, those bond values will go higher.
Richard, you've been in the business, as you say, 40 years, and I mean you've seen all different kind of markets. You've seen all different, talked to all different type of clients and investors. If you had the idea, the thought, you could change the perception or the mistake of one thing that investors make, what would that be?
Not knowing what they own, not knowing concentrations. So we haven't owned emerging markets since '08. And we've been exceptionally and continue to be exceptionally underweight non-US developed market equities. And from an asset allocation standpoint, that's been an exceptional benefit for our clients because those two sectors have severely underperformed the US markets. So by not knowing what they own, investors are basically just assuming a standard allocation to all different asset classes. And those pockets that are underperforming are not monitored. And in addition, the two of them act in a very correlated manner. And it's very important that everything gets reviewed quarterly. And again, should it be held, added to, or sold is a decision that should be made on a regular basis.
Richard, it's been a lot of fun. I hope you come back.
My pleasure, Andre. Thank you.
Thank you, Richard. So, if you have a question or maybe a comment about the show, well, we'd love to hear from you. Make it concise, make it pithy, and write us at andre@benecapital.com. Now, for a wrap-up on Wall Street. First-time home buyers are older. Really, according to the National Association of Realtors, the median age of first-time home buyers has risen 10 years in the past 2 decades from 39 to 49 years old. By the way, first-time buyers in 1981, the average age was 29. And according to the National Association of Realtors, home sales fell to a 13-year low last month because there were so few homes for sale. And those that were for sale, the price of those homes were up. And that's a wrap-up on Wall Street Wrap-Up. Next week will be the first day of December. And with 1 month and 20 days, trading days left in the year, how will the remainder of the year look? And will we be expecting a larger Santa Claus rally than the one we're having right now? So join me when my guest is going to be the chairman of Sanders Morris Harris Investments, George Ball, with just under $5 billion of assets under management. You don't want to miss George Ball next week. And that's a wrap-up of our show for this Friday, November the 24th. Our thanks to Richard Saperstein for being with us tonight. But as always, it's you we appreciate for allowing us into your homes this evening. Have a fun weekend with the ones you love and a good shopping this weekend, too. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde. Also remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.